G'day Gain Squad. Welcome back to Goldie Gains for your latest market briefing. Let's see where the smart money is flowing today as we break down the chaos. Today we are deep diving into the gold market movements from March 15th to March 17th, 2026. We will cover the Strait of Hormuz closure, the oil price explosion, and the RBA interest rate hike. Plus, we will look at the technical levels to see why the market's having a bit of a wobbler. Quick disclaimer traders, this is for entertainment only, not financial advice, so always do your own research. The big question, is gold's dip below $5,000 a classic fake out or the start of a crash? Let me know your thoughts below, and do not forget to smash that like and subscribe button, gold getters. Breaking news first. The Middle East conflict has escalated with Operation Epic Fury, hitting Kharg Island export hubs. The Strait of Hormuz is effectively blocked, trapping 20% of the world's daily oil supply in the water. This is a massive supply-side shock that has global markets absolutely scrambling for safety right now. Gold initially spiked toward $5,400 before things got very weird on Monday. We saw a sharp reversal that shook out plenty of weak hands in the paper futures market. Even though safe haven demand is high, liquidity needs elsewhere forced some big funds to liquidate positions. It is the classic sell what you can, not what you want scenario during a global geopolitical crisis. This is where we look for the signal through all the noise to find a proper golden entry. The volatility is high, but the fundamental reasons for holding gold have not shifted one single bit. We are seeing a decoupling between screen prices and the actual cost of getting physical metal in hand. Let's talk about the energy markets, because crude oil just hit $100 a barrel. West Texas Intermediate, or WTI, is currently trading around $97.07. But the real story is the OVX, the Oil Volatility Index, which has skyrocketed to 121. That is a level we have not seen since the pandemic, showing just how frantic energy traders are. High oil prices act as a massive tax on the global economy, slowing growth while pushing up inflation. Goldman Sachs reckons every $10 jump in oil adds 0.2% to US headline inflation. This creates a stagflation nightmare, where central banks are stuck between a rock and a hard place. For gold getters, this energy shock is traditionally the ultimate propellant for higher precious metal prices. The markets are essentially pricing in a world where energy security is no longer a given. Watch those OVX levels closely, because when energy volatility peaks, gold usually follows suit. In the currency space, the US dollar index, the DXY, has pushed above 100.10. A strong greenback usually puts a dampener on gold, making it pricier for us here in Sydney. We are also watching Japan, where the yen has slid to its lowest level since 2024. The Bank of Japan is holding steady at 0%, but they are watching those oil imports. China is another big player, with their property investment falling 19% and demand for gold rising. The People's Bank of China is still diversifying their reserves, which gives gold a very solid macro floor. Investors are re-evaluating central bank rate paths ahead of the Federal Reserve meeting this week. The DXY strength is a headwind, but it is fighting against the massive geopolitical risk premium in gold. Closer to home, the Reserve Bank of Australia just had their March meeting on Tuesday, the 17th. Governor Bullock and the board decided to hike the cash rate by 25 basis points to 4.1. This was the second hike in a row, following the February move, as inflation remains way too sticky. Trimmed mean inflation hit 3.4% in January, which is above the RBA target band. The board is trying to move policy into restrictive territory to cool down our very hot domestic economy. They are worried that energy price shocks from the war will unanchor inflation expectations for all Australians. The Aussie dollar pair actually got a bit of a lift toward 0.7 after the announcement. It is a tough environment for mortgage holders, but the RBA is taking a least regret policy approach. They would rather hike now than let inflation get away from them like it did back in 2022. This local hawkishness is a key piece of the puzzle for Sydney-based traders managing their portfolios. Beyond the central banks, the de-dollarization theme is accelerating faster than a Sydney morning commute. BRICS nations are making a massive structural shift by treating gold as a primary strategic reserve asset. Recently, we saw gold actually surpass US Treasuries as the world's largest foreign reserve asset. This is a monumental redesign of the global financial architecture that most retail investors are missing. Countries are worried about the weaponization of the dollar after seeing what happened to Russian reserves. They are building alternative payment systems to settle trade in gold-backed instruments or local currencies. This is not just a temporary trend, it is a long-term reallocation that removes physical supply from the market. When central banks stack gold, they create a higher price floor that is hard for paper traders to break. It is all about sovereign flexibility and protecting national wealth from the mess of the global debt cycle. We are looking at a world where gold is reclaimed as the only money that isn't someone else's liability. Some of the biggest names in the game are speaking up, and you better believe they are bullish. Dalio says gold is the safest money and recommends a 5 to 15% portfolio allocation. He warns that we are entering a capital war where fiat currencies are losing their real purchasing power. Schiff is also out there saying the recent 4% drop was just an exaggerated panic move. Schiff thinks gold is entering a new supercycle and could eventually top $7,000 per ounce. He even launched an app for gold tokenization, so you can carry your gold on your phone. Of course, the crypto crowd called it a Trust Me Bro token, but the market cap hit $4 billion. Whether it is on a blockchain or in a vault, the smart money is clearly looking for a way out of cash. These legendary investors are not worried about the daily noise. They are playing the decade-long macro game. If the guys with $15 billion are stacking, it is a pretty good signal for us smart money. Over on Reddit and Wall Street Bets, the sentiment is a mix of fear and buy the dip energy. Some traders are calling gold their sanctuary, while their tech and energy options get absolutely shredded. We have seen some massive losses in the taco trade as leveraged tech bets finally hit a wall. Users are complaining about gas hitting $6 and inflation eating their gains before they even settle. There is a lot of talk about margin calls, forcing retail to dump their gold just to keep their accounts alive. It is a classic liquidity squeeze, where people sell what they can sell quickly to cover their other losses. But the long-term stackers are staying calm, reminding everyone that gold is a crisis-proof haven. They are eyeing the $5,000 level as the ultimate line in the sand for this bull run. Retail volume in defense and oil stocks like ExxonMobil is also through the roof right now. The vibe is definitely risk-off, but the gold getters know that this is when the best entries are made. Let's talk about that paper market flush on Monday, March 16th, because it was a proper doozy. Gold spot prices dropped through the $5,000 level, hitting a low of $4,969. This happened even as bombs were falling, which seems totally counterintuitive if you are new to the game. What actually happened was a cash conversion trend, where institutional investors needed liquidity fast. When the stock market gets hit, big funds face margin calls, and they use gold as their personal ATM. They do not sell because they hate gold, they sell because it is the only thing they have with a profit. This creates a temporary price dip that has nothing to do with the actual value of the yellow metal. By the London lunchtime session, gold had already started pairing those losses and stabilizing a bit. If you can survive these liquidations without panicking, you are already ahead of 90% of the market. It is about understanding that paper contracts do not always reflect the reality of physical supply and demand. Speaking of physical, the premiums on actual gold bars and coins stayed massive throughout the price drop. This is a huge signal that the smart money is not letting go of their physical metal during the volatility. While paper traders were panicking, central banks and institutional buyers were quietly scooping up the dip. JP Morgan and Deutsche Bank are still holding their year-end targets of over $6,000. The structural supports like the $36 trillion of US debt have not changed at all. If anything, the Iran war has just strengthened the long-term case for owning gold as a hedge. We are seeing a shakeout of weak hands that resets the market for the next leg toward new record highs. Every major bull market in history has had these 6 to 8% corrections along the way. It is healthy, it is normal, and it provides a way for the latecomers to get a decent entry price. So do not let the red candles on your screen scare you out of a high-conviction long-term position. Looking at the macro horizon for the rest of 2026, the stagflation risk is very real. We have slowing global growth and sticky inflation, which is gold's favorite environment to perform in. The Fed is stuck between fighting oil-driven inflation and preventing a complete labor market collapse. February jobs data showed a loss of 92,000 positions, which is a major warning sign. If the Fed pivots to rate cuts to save the economy, gold is going to absolutely rip to the upside. If they stay hawkish, the debt interest costs will eventually break something in the financial system. Either way, gold acts as the ultimate insurance policy for your portfolio during these uncertain times. We are seeing a shift in global power that gold has been predicting for the last 12 months. keep your eyes on the $5,000 level. It is the psychological magnet everyone is watching. Let's optimize this entry with a look at the latest technical analysis indicators from the March 17th session. Gold spot is currently trading around $5,016.30 after Monday's dip. The Relative Strength Index, or RSI, is sitting at 48.8, which is essentially neutral territory. We have seen a death cross on the 1-hour chart, but it is just capturing short-term seller momentum. On the 4-hour chart, we are seeing a Bollinger Band squeeze, signaling a massive move is brewing. The 50-day simple moving average at 4,953 is our major structural support floor. The MACD is currently in a sell position at -10.3, showing some lingering bearish pressure. Strong resistance is clustered around $5,100 and then $5,180. Reclaiming $5,100 on a closing basis would confirm this is a proper golden entry. To summarize, gold hit a low of $4,969 during a Monday liquidity flush. The Strait of Hormuz closure and $100 oil are the main drivers of global stagflation fears. The RBA hiked rates to 4.1% on Tuesday to combat resurgent domestic inflation pressures. DXY strength is a headwind, but de-dollarization by BRICS nations is providing a rock-solid long-term floor. Famous investors like Dalio and Schiff remain ultra-bullish, calling gold the safest money in this capital war. Technicals show a Bollinger Squeeze on the 4-hour chart, hinting at an explosive directional move very soon. Support is firm at 5,000, while resistance is clustered around the 5,100 level. So, traders, what is your move? Are you buying the dip or waiting for a breakout above 5,100? Drop your price predictions in the comments. I want to know where the smart money thinks we are heading. Make sure to like the video if you found this ripper and subscribe to Goldie Gains for more updates. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.